Welcome to the What to Watch video update. This is the last video that I do over the weekend where I pull out the charts that seem to be really saying something right now. If you've watched any of these videos before, yeah, there's charts that I pretty much show every time because these are the charts that I really focus on. But I take those charts and I put them into a positive area, a negative area, and then just things that I'm keeping an eye on for right now because they may not be directly involved with the S&P 500, but they can influence what the S&P 500 does. And we're asking the question this week, can the S&P 500 make a new all-time high? And it's being prepared for Monday, June 9th. Before diving into today's video, if you find it helpful, consider a 30-day free trial to the SPX investing program. This trial lets you explore my unique approach to market analysis. Full-length daily and weekly videos are available on a delayed basis after the market closes. For immediate access, become a member by clicking on the link below. Okay, first we go through the positive side. Now, as always, there are some positive things that you can take away from these charts, but I'll also try to point out any negative things, and I'll do the reverse of that when I get to the negative side. And there's even a chart or two in here that you could probably put over on the negative side. So I just take all the charts, I try to organize them and come up with what I think is looking more positive or negative, realizing that it can change at any time. Okay, so we had an up week. We were up 1.5% on the week, and most of that gain really came in Friday's session. Now, we did see a good Monday, and Tuesday was going up pretty well, and then we just chopped sideways Wednesday and Thursday. But the employment report, which came out better than feared, was that we actually saw jobs coming in above what was expected. The unemployment rate, which is completely manipulated, that stays the same, but it's a round number that people can point to and politicians can use. But there's been some fear that, okay, are we going to go into a recession? The economy seems to be slowing down. Some of the economic reports that are coming out were weaker than expected. And one of the areas that we really keep an eye on is employment. And if that really starts to nosedive, then yeah, it looks like we're probably going to go into a recession. But for right now, it's holding up. And so that produced a gap higher right at the open on Friday. And we closed pretty much at the high for that session and pretty much at the high for the week. Now, as you'll see later on, we're not trending right now, either in the short or intermediate term. We're improving in the long term, and I'll show that when I get to the ADX charts. But that's been a lot of the frustration. We see below average volume. We see a real lack of conviction, but at the same time, anytime there's even a little bit of weakness, the buy the dippers are coming in thinking that we're just going to automatically keep going up. And that's kind of a dangerous place to be. But we're still looking positive nonetheless. Now, this is just the daily chart where we've been chopping around in this range. We did break out a little bit. Now, we did close off of the high here. Even though we closed near the high, we saw a lot of the real strength from the gap. And we closed right at 6,000, which is a psychological level. The financial media likes to point that out. It's an easy number just to point to. And that had been acting as overhead resistance. Then in Friday's session, it also acted as support. Are we going to be able to see a bit of a breakout here and go back and at least give a try at the previous all-time high? Now, we are looking okay as far as the bar pattern here. We had that big down day in there, but we're seeing a series for the most part of higher highs and higher lows, and that's good. But we've also really just been chopping around. Now, if we start to come back down, we'll probably fall back into this range and continue to just chop sideways in a more trendless environment. One thing that is a bit concerning, though, is that we continue to drop off with volume. And we're below the moving average, and the moving average has been declining ever since we saw that massive influx of volume as we were going down. We haven't necessarily been seeing it matched up as we're going back up. You've got a lot of folks that are apprehensive right now. Okay, now as far as sentiment, we're positive for the time being. We were really coming up after we hit the bottom in April, and we were just camped under 25 for a while, but we were there for a long time. And then once we get above 25, we tend to go with the direction that this line is going. So if it's going up, we're positive. Now we came up here and then we started to drop off as far as sentiment, and that was turning it more negative. This past week did see sentiment improving. So now we're looking at this being positive. We are under 20 with the VIX, and when we're under 20 with the VIX, that is more positive for the market. We're still getting high readings. We're still in the 16 range, but that's kind of the equilibrium. When we're at 16 or so, then it just means, okay, maybe the buyers are coming back in control. And then if we can drop below the 16 level, that means that even more fear is coming out of the market. And when you look at this on an annualized basis, this was research that was done by Tom Bally, who's connected to stockcharts.com and earningsbeats.com. When we're above 20 with the VIX, that's when we see negative annualized returns. When we drop below 20, that's when we see positive annualized returns. The further below 20 we go, the better those returns end up being. So we're under 20, we're more a little bit under the 17 level here. So we're currently, anyway, right around the 30.97% as far as annualized returns. Okay, then we're looking okay when we look at the intraday chart of large cap growth versus large cap value. The blue line is above the red line. And we're looking pretty good here when we look at S&P growth of value on the intraday chart. We started to come up out of that in late April, and this is holding up fairly well. And then we look at some end of day charts, just first by looking at the small caps. We're above the moving average and we're going up here, even though small caps are just kind of chopping along sideways. They had a pretty good week with most of their gain coming on Friday, but price action for the index has been really dismal. I mean, we came up after going down, but we've been chopping sideways here, but they just have been underperforming as a group when you compare it to other areas of the market. But when you look at the growth to value ratio, this is looking more positive, and we're also looking more positive with mid-cap growth to value, even though the mid-caps are just chopping along in a sideways trend as well. Then we look at S&P growth to value ratios here with the Qs to S&P, and Qs, that's growth compared to the SPY, which is growth and value. And when we're above an advancing moving average, that's positive. Now, if there's a negative takeaway, it's discretionary to the S&P. It's falling down below the moving average, and the moving average is rolling over. Now, this whole tiff between Musk and Trump, of course, the media loves that stuff, and it gives all kinds of folks something to work with and topics that they can talk about. But Tesla got hit really hard on Thursday. They got some of it back on Friday, but that's really taking down the whole discretionary sector for right now. We'll see if we can get some kind of a bounce out of that. But we are looking okay when we compare large cap growth to value. And when we look at the main indexes, large caps, mid caps, small caps, doing okay right now and actually looking positive. And then we look at S&P growth to value on an end of day basis. We're above the moving averages, and we're just about ready to see a golden cross here with this ratio, and that would be more positive. And we compare a growth ETF versus a value ETF. We're above the rainbow. We've just been kind of chopping around here, but for the most part, this is still holding up and looking positive. And this is doing okay right now when we look at the equal weight. Now, what I showed you earlier with discretionary, that weights a lot for Tesla, and Tesla and Amazon are the biggest stocks in the discretionary sector. And so if either one of those has a bad day, that really brings the overall sector down. This looks at an equal weight version where it treats all the stocks the same in the discretionary sector. And then with staples, which are toilet paper and toothpaste, and we're holding up okay here. We came right down to the 200-day moving average, and then so far we've been able to stay above that. You can see the equal weight just kind of chopping along sideways, as are the staples here. And we're seeing a little bit of outperformance by discretionary, but that would really help the market for discretionary to do better. Large cap growth doing okay. We're above all of the moving averages, and we're starting to see some moving averages cross here. This 200 period moving average is now starting to cross back above the 100. What would make it be in an uptrend is that the 50, which is here in blue, that comes and crosses back above the 200. We look at a risk on to risk off ratio. This has been coming up since the April lows, and so far it's holding up okay. If this keeps going up, that would be more positive. And then we look at those stocks in the S&P above their 20-period moving average. Awful lot of chopping around here, but most of this, in fact, all of this, has been above 50, and that's the line between positive and negative. So right now we have 63.6% of stocks in the S&P above their 20-period moving average. And we're also still positive here with those stocks in the S&P above their 50-period moving average, 100-period moving average, and this has been chopping above and below the 50 line, but right now we have 52.2 stocks in the S&P above their 200-day moving average. High beta versus low beta. Again, this is another form of risk on, risk off. When this ratio is going up, that is more positive for the market. And this is improving. Now, I did a special video week and a half ago or so talking about this particular chart because we were concerned when we were coming down here that we were falling apart in a similar way to how we were falling apart in late 2021, where this ratio really started to go down. Then we set an all-time high with the S&P and then ended up going into a bear market in 2022. Well, we saw this really falling apart as stocks were going down, but we're seeing quite an improvement here. Enough to actually say this chart is positive now because we're above the majority of the rainbow. If this ratio goes up, that just means the S&P is outperforming the staple sector, and staples are more defensive. And we're doing okay here with our weekly chart of the S&P. We're above the pivot point. We did break out a little bit from this range that we've been in. So this is looking better, we being up 1.5% on the week. But on the bottom, you can see where we are below average, even on the weekly chart. And this is positive too. This is kind of reverse psychology here, where we look at value first and compare it to tech, which is the main growth area of the market. And when this ratio is going down, that's actually positive. That means tech is outperforming. So we were concerned back in late March and into April when this ratio was going up. Now it's starting to retreat, and that's more positive for the market. We're holding up okay here with the advanced decline line based on price and volume. We're above the advancing moving averages, not really breaking out to new highs yet, but just holding up nicely. And we're back above zero with our advanced decliners oscillator. It calculates things over a 10-day period of time. We had dropped below zero, and even when we were having up days, this was still going down. Well, after Thursday and then Friday, this actually showed some improvement. Even though we had a down day on Thursday, there was some internal buying that was going on to help this chart improve, and it did even better on Friday. We're above zero with the short and intermediate term advanced decline ratio. And then this is that same chart, but it also includes volume down below with the advanced decline ratio. And we're above zero here as well. And we're improving with our internal measures. We look at the new highs versus new lows. We're going up with the 5-day chart and the 10-day chart. And so we're seeing a lot more green than red currently, and that is positive as well. Now we're positive here, but this has been kind of tricky lately. Accumulation distribution. This is a smart money indicator. Now we're positive because we're above the moving average, and the moving average is still going up. And the boom indicator tries to measure, okay, how is this going up or down in relation to the moving average? It's not a peer study, but we've been just chopping along sideways here. We have a down day, we would drop a little bit below the moving average. Have an up day, we would go above it. Thursday, we went below it. Friday, we went back above it. That's a little very short term, a lot more short term here. But in the bigger picture, we are still positive with this chart. And we're positive, but showing some weakness here with the vortex. The green line's coming down, even with the up day that we saw on Friday. This still came down, but we're also declining a little bit with the red line, which is selling. This is positive and a little bit longer term. It's a 10-day average of the highs and lows for the S&P. And we use this like an oscillator. When we're above 50, that's positive. Below 50, that's negative. How this goes, excuse me, how this turns into an oscillator is when we go above this green line, that's 90%. That means that 90% of the stocks in the S&P are having an average of of their new highs minus their new lows above 90. And this can stay that way. And this usually shows good upward momentum. Now, we're not quite to this green line yet, but if we continue to go up and get above the green line, that would be more positive. Then we look at some different trend studies. The first one is a short-term rainbow going from 10 periods to 50 periods using simple moving averages. And we're going back up. We're above all the lines in the rainbow, and all the rainbow lines are starting to go back up as well. That's just showing an improvement in the short-term time frame. Now, the intermediate term, not so much by this chart, but it's been holding up. We've been above the rainbow, but when we look at other charts, you'll see the intermediate term trend is actually holding up better right now. It's more the short-term trend that has really been kind of bipolar these days, but we're above the rainbow. The lines are starting to turn back up. Now, we look at a long-term rainbow going from 50 periods up to 250 periods. We're above all the lines, and the longer we stay above these lines, the more they will start to turn back up. So we're showing some improvement there. This is what I mean by the short term. We've been kind of chopping along sideways here, and I use a double and triple exponential moving average based on 20 periods. And this moves really fast. And when the green line's above the blue line, that means we're really going up pretty quickly here. But then we kind of stalled. We've been chopping sideways. Well, we're starting to go back up now. So for right now, it's looking more positive. This is what I mean by the intermediate term trend based on 50 periods. Even with the sideways chop, we were just coming back down and actually used the triple exponential moving average a couple of times as support, and we're able to bounce up off of that. And the red line and the blue line, they're still continuing to go up. So that's looking more positive there. And we're above all the moving averages here with the 20 period, 50 period, 100, and 200. It looks like a spaghetti mess here, but as long as we stay above all of the lines, then the lines continue to go up, and then eventually we might, if we keep going up anyway, we'll smooth things out and show more of a convicted trend. But we're getting far away from some of these moving averages. This is another use of the boom indicator, which measures how far away are we from the 20, 50, and 200 period moving average. And after Friday's close, we're getting kind of far away from the 20 period and the 50 period. We're still looking positive. We're above zero when we measure how far away we are from the 200 period moving average. And this is staying more short to intermediate term. This is called a bow tie. And what I was really honing in on through the daily videos is that this green fluorescent line was pretty much going sideways. It had flattened out. Now it's starting to turn back up, so it's turning more positive. Now the 20 and 30 period exponential moving averages, they're continuing to go up. We are more positive here when we see green above orange, above blue. So that's still looking positive altogether. And we were kind of dropping below zero with the S&P McClellan Oscillator, but we saw some strength coming back in Friday's session, just enough to get us back above zero. And when we're above zero with the McClellan Oscillator, it's really hard to see here, but we should be positive with the summation index based on price and turning up just a little bit here based on volume. And then we were below zero and chopping below it with the NYSE McClellan Oscillator. This is a broader market measure, but in Friday's session, we were able to come back above zero. And so we're ever so slightly starting to turn back up with the summation index for the NYSE based on price and volume. And the swollen trading oscillator, which had turned negative after Thursday, it turned back to positive after Friday. We're pointing up based on price and volume. And the parabolic SCR. Now, there's no ambiguity with these charts. It's either positive or negative. So sometimes it's not as helpful. But when the dots are underneath, that just means that we are positive. And then the weekly chart, again, we've been chopping kind of sideways, although we did close at pretty much the high for the week. We're also underneath with the dots here on the weekly chart. And in Friday's session, we had a new X drawn in here on the point and figure chart. So that's positive. And this is being called an ascending triple top breakout that was generated right in Friday's session. And that's more positive. This doesn't take time into account. This just takes price into account. And there was enough of an upward move to draw in this green X. And we're looking positive again. We were a little concerned here earlier in the week. even when we would have an update, the bullish percent index, which measures the point and figure buy or sell signals inside of the S&P, it takes all 503 stocks. Well, we were coming down and we're actually below the moving average. But even in Thursday's down day, we saw this bouncing back up and it's continuing to go up above its moving average after Friday. We're starting to go back up and above 50 with the NYSE bullish percent index, and we're turning back up after we have been declining with the NASDAQ 100 bullish percent index. And this is already extreme. We're above this 70 level. So we want to be a little concerned about that because it doesn't mean there's an awful lot of room left for this to go to the upside for the NASDAQ 100. And we're getting a praying bottom fisher buy signal. Now, some of these signals are very good. Some of these are very bad. So I wouldn't necessarily use this independently. We kind of only know in hindsight, oh, that ended up being a good signal. Oh, that was not a good signal. So it doesn't produce sell signals. It just produces buy signals. And we've crossed above the moving average. So that is also considered positive. And we're looking at the ratio here going up a little bit, and that's positive when we compare the S&P to the utilities. That means the S&P is outperforming utilities, but we need to see more follow through with this. And then we were getting concerned here. We look at bonds to stocks. So this is kind of inverted to what you might think. I have some other charts that look at stocks to bonds, where when we were really going down, bonds were outperforming. Now they've been falling back. And as long as this ratio continues to go down, that's more positive. The advanced decline line across the broad market is still holding up. We're above the moving averages with all of the indexes that we follow. And the 200-day moving average has been a real trouble, a real problem spot for the Dow. Well, we finally were able to get above it. And it seemed like we closed above it one day, then we closed on it, then we closed down below it on Thursday. We got above it on Friday. So I'm treating that more as positive for right now, but not an awful lot of conviction here. The Dow isn't really breaking out of this range that it's been in lately. And we are looking a little better when we look at the bar patterns here for the NASDAQ. We had a down day on Thursday, but we were really able to come back. Now, this looks like a doji. It's really hard to see, but the open and the close are pretty much equal with each other. That could be a little bit of a concern. But for the most part, we're seeing a series of higher highs and higher lows as we've been trying to break out of this sideways pattern. And we're seeing pretty much that same thing with the NASDAQ 100, showing some improvement here as well. And the Wilshire 5000 above its 200-day moving average, still in a downtrend though, but it also was up over 1% on Friday, and we're also improving with the total U.S. stock ETF. These are the Wilshire, the previous chart, and this. These are some broad market measures that would give us an idea of what's the bigger picture doing, even bigger than the S&P 500. Financial sector, looking okay here. It was up in Friday's session, chopping sideways, kind of like everything else, but it's still in an uptrend. But, and I wanted to keep this with the financial sector. The next chart, though, we're starting to underperform here when we compare the financial sector to the S&P. We want the financials to outperform. That really helps the market to go up. And this is a little bit of a concern that this is starting to fall back. Now, it could come back and roar back up here with the ratio, but we just want to keep an eye on this one as well. And the staples to tech ratio, staples, toilet paper, toothpaste, tech, growth. When this ratio is going down, that's more positive. Now, we've been down here before with this ratio, but we need to see this continue to fall. But the fact that it's falling right now is positive. And then we look at the QQQs, which is growth, and then the small caps. We're still seeing this ratio holding up quite well. The FAANG index setting an all-time high and did have a good week. And these are the big stocks: Facebook, Apple, Amazon, Netflix, Google, Nvidia. And it's looking, at least right now, this could always change, but we could be getting back into a place where the bigger stocks are going to assume some leadership. Now, that's pure speculation at this point, but it does appear that we're shifting over into that. And if that's actually true, that could really help the indexes go up. Now, if we start to see follow through weakness in the really big stocks, then that scenario will get thrown out, and we would probably see the FAANG index come back down. But we did generate a golden cross here right at the beginning of June. So this is setting an all-time high and now going into an uptrend. For right now, it's looking quite positive. And then we do a ratio between stocks and bonds. We're coming up back out of the rainbow, and some of the rainbow lines are starting to turn back up. When we're above the rainbow and going up, that means the market's anticipating a soft landing, meaning that we're not necessarily going to go into a recession. And that was proven out in Friday's session with the employment still holding up for right now. So if this ratio can continue to go up, that would be more positive. That means stocks are back to outperforming bonds. And then we use a lot of different measures to kind of confirm that. This is the S&P 1500, and we look at a ratio with 1 to 3 year bonds, also starting to come back up out of the rainbow. Then a broad market measure, another broad market measure, and then we use 3 to 7 year bonds, also coming up out of the rainbow. That's improving. The tech sector to 3 to 7 year bonds coming up out of the rainbow. And the QQQs, NASDAQ 100 to 3 to 7 year bonds, also looking much improved right now. And then we look at a growth versus value ratio here. The growth is the NASDAQ 100 compared to the Dow. Yes, there are growth stocks in the Dow, but when we compare the two, we're well above this red line and continuing to go up, and that's more positive. That means growth is outperforming value there. And this is a broad market measure. We look at a 5-period moving average of the highs minus the lows across the Amex, NASDAQ, and NYSE. And we're above zero and continuing to advance. So that's positive. And then we look at a 50-period moving average of the new highs and new lows for the S&P. So longer term, we had dropped below zero and we're actually turning negative. Then we started to come back up. We were improving, but now this is actually turned back over to positive. And that just shows internal strength building in the S&P. And we're still going down with the Staples to S&P ratio. As long as this ratio goes down, that's more positive for the S&P. That means the S&P is outperforming Staples. Mastering the stock market is challenging and can take decades to achieve. Most beginner traders and investors feel overwhelmed and often fail. Stay ahead with the SPX investing program. Members gain access to the full program. Other options include immediate access to videos as they become available. Alternatively, the daily and weekly newsletters may be helpful. Click on the link below to find out what's best for you. Now we go to the negative side. We're not trending right now. Possibly a little bit of exhaustion here. We've been just chopping around sideways, and even in the short term, we're positive because the green line's above the red line, but we're still below the moving average when we look at the short-term ADX. And we're also below 20 with this. So what we need to see happen here to show that we're turning into a trend and it's positive, we need the green line to stay above the red line, and then we need to see some more follow through to the upside and then see this turn back up and actually cross above its moving average. That would show the trend is starting to get stronger. When it's a confirmed trend is if we go back above 20, and right now we're going further below 20. And we're seeing that same thing here in the intermediate term, but we're still positive with the green line above the red line, but we're declining below the moving average and below 20. And now we're seeing a little bit of a shift here. This is a weekly chart of the trend. It's still negative with the red line above the green line, but we're dropping below the moving average, suggesting that it's a weakening trend now, but it is a trend since we're below 20. And we're still negative with the red line above the green line, but the red line's coming down as the green line's trying to come up. Now this is longer term, and this takes longer to develop and actually change. Where we had been quite negative, this is showing some improvement though, and we're still negative technically. Now the Chaiken Money Flow, this is another smart money indicator, and there are 3 of them. I showed the accumulation distribution on the positive side. This is just going flat right now when we look at the red line. Now, we had been going up, then it looks like we were starting to go down. Now we're coming back up a little bit again. Really choppy at this point. It is improving, but I'm treating it more as negative until we see more follow through in the upcoming week to the upside. And we're still negative, though, with the Chaiken Oscillator. And that's even after Friday's upward move. This had come right up to the green line. That's when we really start to pay attention to this chart, meaning maybe we're getting extreme. Now we're starting to come down, and we continue to decline even after Friday's positive day. So, and this is smart money indicator number 3. And we're continuing to go down with the TTM squeeze. Now, I know some of you watch these videos. You're big TTM squeeze folks. You really like it. And it's good, but I don't even consider it one of the primary indicators personally. But some of you may disagree with that. Last week, I showed a monthly chart that seems to be a little bit more realistic, but This has really come up to an extreme reading above this black line, and it's been declining. And when it turns darker blue, that's negative. And then we came back down below the black line. And even with the update on Friday, this is still continuing to decline. So sometimes this can be a really helpful indicator. Other times it's like doing the exact opposite of what we see happening in our other charts. Now, momentum, we're just not seeing much. And when we look at the short-term daily chart here, this is the slope oscillator. It's actually negative. It's still extreme positive because it's above the green line, but it's declining below its moving average. Then we have another short-term oscillator, which is just kind of going sideways, slightly positive. You have to break out the magnifying glass, but it's a little bit above the moving average. Then we switch over to the intermediate term, the MACD actually declining. And we're flat here with the PMO, but still above the moving average. And we're starting to decline with the PPO. And then we have two long-term oscillators, the TRIX, which is just starting to cross below its moving average, and the KST, which is already starting to drop below ever so slightly. You have to break out the magnifying glass for that one too. But this just shows the lack of trending that we've been seeing. It's actually more negative after being extreme here with the slope oscillator. But have we kind of limited what momentum is capable of? Because a lot of these are still giving us extreme positive readings. We're above the blue line here with the TRIX and the KST. That's long term. We're coming down, but still above the green line in the short term. And we had even here with the PMO, this is still a high reading, even though it's chopping sideways. And then the Copic curve, a little more touchy momentum oscillator. It actually started to cross over negative and is continuing to decline here. And then we have this thing called the Zahorchak method, which is quite long term. And we had been up at 10, and then we started to drop down to 8, and then we dropped down to 4, and now we're down to 0. So the reason why this is negative is because the context is we're going down, but it's still neutral at this point. Now, if we drop below 0 and start to turn negative, that's going to be longer term negative, but we could also bounce back up. We've been down here before, and then we're able to recoup from that. And we're seeing a little bit of a disconnect between the weighted version of the S&P, which is the bar chart, and then the red line, which is the equal weight version of the S&P. Usually these lines, we want to see them more closer to each other, but we're seeing the red line below the green line. Yes, they're on different scales and they're calculated in a different way. But you can see when we were really coming up out of this, the red line and the bar chart were pretty much in tandem with each other. And we're seeing a little bit of distance between the two right now. That's the negative side. Now, on the positive side, as I said earlier, if the really big stocks are coming back in and they're going to take a leadership role and really help the market to go up, we don't mind this. We want the S&P, the weighted index, to actually do better than the equal weight version. But that's why we watch the really big stocks to see how they're doing. All right, and then the momentum for the NASDAQ 100, after getting really extreme with the PPO, it's actually declining. It's below its moving average. And small caps, I have it on the negative side. Even though they had a pretty good week, we're just kind of back to where we were before. And we see the small caps come to life and then give it back. Come to life, give it back. Is that what's going to happen this time? We are in a downtrend with the 50-period moving average below the 200. We're above the 50, but below the 200 here. That's why we're still longer-term negative with the small caps. And then we look at another small cap index, the Russell 2000, and we're still below the 200, above the 50. We are looking pretty good here with the RSI. It's above 50 and going up, but it might be getting extreme. And we're trying to turn positive here with the MACD, which measures shorter-term momentum. So not full-blown negative, but over the last few years, folks have been completely fooled by the small caps. It looks like they're breaking out, like back here, back in November. Break to the upside, looking really good, give it back. Break up, give it back. I mean, it's been very frustrating to deal with this part of the market. And then the bank ETF, the reason why this is negative is we're still below the 200-day moving average. And if we could go back up with that and see the ratio between the financial sector and the S&P improve, that would help things turn more positive. And we're improving here when we look at the risk. This is kind of a risk on to risk off using bonds to see what's happening here. The riskier bonds, these are junk bonds, and then we compare them to conservative bonds, government bonds. When this ratio is going down, that means government bonds are outperforming. And that's what had been outperforming as the market was really running into problems. We're still negative here because we haven't broken out above the rainbow, but we are improving, meaning that folks, if they're willing to assume more risk, that tends to be more positive for the market. And so the fact that this is coming up is good, but it'll actually turn positive if we can come back above the rainbow. And then I did extend this out. The reason this is on the negative side, we're going up with the NASDAQ 100 weekly chart, and we were up almost 2% for the week, but we're coming up to this trend line that goes back to 2009. And the reason it's negative is, if we continue to go up, is that going to produce some kind of overhead resistance? And bonds are back above the 4.5% level with the 10-year yield, and that tends to be negative for stocks. And home construction, we're still seeing, for the most part, the ratio going down when we compare it to 3 to 7-year bonds. As I typically point out, this was the first area to kind of fall apart at the end of 2024. This was giving us some warning signs that all is not wonderful in paradise. And then this just kept going down, and it's still pretty much going down overall. Then we look at a long-term special K chart. This is a daily chart here where we're still below the moving average. And so that's why this is negative. But, and this could be on the positive side, but I wanted to keep these charts together. The weekly chart came right down to its moving average. Now the moving average is starting to go down, but we're so far bouncing up off of this moving average. So that's longer term positive still. And we look at a ratio between the semiconductors growth and the Dow, which is value. And even though we improved here, we're still not breaking out of this series of lower highs. We really need to see this ratio coming back up to turn more positive. Semiconductors, negative down. That's why they're on the negative side. We're in a downtrend. The blue line's below the red line, but we're above both of the lines. So we are improving here. We're also improving. We're trying to come back out of the rainbow when we look at the SMH ETF. And then we look at the Dow Jones Semiconductors, because this is such a massive part of growth. It's a huge part of tech. And if the semiconductors are doing well and tech is doing well, the market is doing well. So we are improving here. And then we look at a ratio between the semiconductors and the tech sector. When the semis were really taking a leadership role, this is when the market was really going up. Now, to kind of go against that, this ratio was really coming down last summer and into fall, but the S&P was still going up. We were starting to see rotation into the broader market. So it's not a hard and fast rule, but if the big stocks, and that includes a lot of semiconductor companies, if they're coming in and taking a leadership role, we want this ratio to actually break out above this previous high and continue to go up. We want tech to do well too, but we want semis to do even better. And that's what happens when this ratio advances. And retail, when we do a ratio here, this is actually negative. It's still continuing to underperform the S&P. But when you look at retail by itself, it is improving as well. It came back above its 200-day moving average and is starting to come back above that. And we're above 50 and advancing here with the RSI. The momentum stocks, the reason they're on the negative side is they were actually outperforming. And now that at the beginning of June, as we are possibly seeing some kind of a shift in the market, the momentum stocks are starting to underperform. So we just want to keep an eye on that. But as we were really going down, these stocks held up better. And so that was more positive. And that gave us some confidence that maybe when we hit that low, we were going to bounce up out of that. The fact that this is going down, we just want to keep an eye on this because it could possibly turn into something more negative. And U.S. stocks still continue to underperform international stocks, and this is not a trend line, but this just shows how the ratio has been going down as U.S. stocks have been underperforming. Now, lately we've been chopping around sideways, so we are seeing some improvement. We're not seeing an all-out decline anymore, but we want to see this ratio go back up, meaning that U.S. stocks are outperforming international stocks. And then we look at emerging markets, which are underperforming developed markets. And a lot of times when this ratio is really going up, that means emerging markets are doing better. That's more risk on, and that tends to be more positive for the market. But overall, they have been underperforming. Now, developed markets would be like the US and Europe. And so this ratio going back up would be more positive for emerging markets. But this going down just shows that especially Europe has been holding up better than the US market has been. And that's kind of keeping things more positive with this ratio, even though it's been declining. This just measures that the emerging markets are still underperforming. And this measures US stocks against German stocks. Now, we have the EU, but Germany has the biggest stock market in the EU, really underperforming right at the beginning of 2025, and it's still kind of down here right now. We want to see this ratio go back up, meaning that US stocks are starting to outperform. With each video and course, members learn to implement the consensus approach, a unique analytical method. Unlike relying on a few indicators that eventually fail, this approach overcomes analysis paralysis by using the weight of the evidence to draw conclusions. Developed over decades across all market conditions, explore the SPX investing program and start with a 30-day free trial. Then some areas that we're watching. Jobless claims. Now, they did go up and they were higher, and that kind of freaked everybody out on Thursday, but we're still kind of within this range. We really only get concerned about this when we get above 300,000. So the choppiness that we've been seeing is not all that concerning right now, but we want to keep an eye on this. And then if we get above 2 million here with the continuing claims, that's when we start to get concerned. We're at 1.9 million now, and this actually came down in the latest trading, but the moving average is continuing to go up. This plots everything together, showing how initial claims went up. We came down with continuing claims, and we're still at 4.2% with the unemployment rate, which was updated on Friday. And this is also another concern. We continue to be below average with volume. Now, there was that end of the month day when they were doing a lot of window dressing and repositioning. We saw volume really spike that day, but for all the other days, we're just not seeing an awful lot of conviction right now. Now, I put a lot of importance into volume where other people don't, because there are transactions that take place off of the exchange that's not calculated in here. But you can see when we were really coming down, yeah, we were above average with volume. And then as we've been going back up, we've been dropping below average with volume, with the exception of just a few days here and there. And that's a technical analysis negative divergence that is just causing a little bit of concern. But at the same time, you can kind of understand that because we've got now, as I'm recording this, there's some kind of riots breaking out in Los Angeles, and there's the trade wars and the tariffs, and what are they going to do to impact the economy? And the country is so divided, those people that hate Trump and those people that love Trump. And if you're looking to put a lot of money into the market, it's like, would you do it right now? You might wait until things appear a little bit more clear. And so that's why we consistently are seeing below average volume. So you can understand it, but it's still a negative thing in the bigger picture. And we want to keep an eye on the spread between cash and 3 to 7 year bonds. It did spike up because we saw interest rates really going up in Friday's session, but we're still in a downtrend here. When this ratio is going up with conviction, that means the market is concerned about inflation and interest rates. And we've been just chopping sideways. So on a short-term basis, the market's not concerned about inflation or interest rates. Then we do that same application to TIPS, which are Treasury Inflation Protected Securities, which do adjust for inflation. This is what folks get into when they're worried about inflation going up and interest rates going up. And we were starting to see that back in 2024, and that was causing some problems in the market. This ratio is now continuing to go down, and it's in a downtrend. So this suggests, still on a shorter term time frame, that the market's not worried about inflation. And we go out to 7 to 10 year bonds, also not really seeing a lot of concern right now. Then we want to keep an eye on the spread between risky, like junk bonds, and not as risky bonds, like government bonds. We're not really seeing any problem here. When this really declines, that means there's a lot of fear coming into the bond market. And as we've been going back up from the April lows, this has been going back up as well. If this continues to go up, that would be more positive for the bond market, which is a sentiment gauge. That's how I use this. And that quite often will feed over into the stock market. Oil. Now, OPEC did come out, OPEC Plus or OPEC, whatever acronyms. We have so many crazy acronyms these days. But they came out and said, yeah, we're going to pump out more oil starting in July, which has been keeping it down in the low 60s. But we did see it come back up. Now, we watch oil mainly from a production standpoint and how it's acting just as its own asset. But we also watch it for geopolitical reasons. And sometimes when we see these big spikes, this is right when the Russia-Ukraine war started, and we saw this really spiking up and then coming back down. It's not really presenting a problem. at this point, at least from a geopolitical perspective. And then we look at some different sectors and how are they doing. On the top, we have the weighted version of discretionary to staples, and that's kind of chopping along sideways after it had been improving. Then we look at the equal weighted version of discretionary to staples, and that's what I showed earlier, but I wanted to include it with this other charts here. This is still holding up okay. And then we look at tech, which is growth to utilities, which, yeah, you can make a case that they're growth, but pretty much they're considered to be value. This is showing some improvement here. We're improving when we look at biotech, which is growth to healthcare, which is value or defensive. And this is improving. And then we look at hotels to utilities, not improving as much as some of the other areas, but it did go up in Friday's session after it had come up, fallen back, and now it's starting to show a little bit of life again here. And then we look at what are called bellwether industries within the US. Semiconductors are a huge part of that. Pretty much chopping sideways right now. Home builders, still looking more negative overall. Going sideways with the transports. Retail is improving, and that's a big part of the U.S. economy, so that could be good. And the regional banks, not falling apart, but not really breaking out. They did have a good update on Friday, but we would like to see this continue to go back up. And when you see a lot of sideways action with these bellwether main industries in the U.S., that's why we're not trending right now with the S&P. And we want to keep an eye on the gold to SPY ratio. We came right up to this yellow trend line and hit that. And now this just shows that the S&P has been outperforming gold more recently. We want to keep an eye on the dollar. And yeah, I'm hearing the rumors that maybe they're purposely trying to take the dollar down because that helps the stock market. It helps for imports and exports. It sucks if you're going to travel, but you're going outside the US and you want a currency exchange. But it tends to help the market when the dollar is actually weaker, and it's weaker now. It's under 100 and in a downtrend. And we want to keep an eye on the German DAX. It was down a little bit on Friday, but just setting a new all-time high. It's a stronger market these days. And then these are the pivot points which have been posted on the YouTube community tab. This is what we're going to be following intraday in Monday's session. So thank you. I hope you found this helpful. I hope you're having a wonderful weekend, and I will talk to you in the next video.